Welcome to the Financial Freedom Secrets Show. This is your host, Jackson Millan, the Wealth Mentor, helping business owners create financial freedom faster by mastering the language of money. Want to see how well you're tracking towards financial freedom? Complete our 40-point financial performance scorecard at wealthhealthcheck.com.au. That's wealthhealthcheck.com.au. The average score for most business owners is 18 out of 40. So complete the scorecard now and see how well you're tracking towards financial freedom. G'day guys, this is Jackson Millan, the Wealth Mentor, and we're here for another episode of the Financial Freedom Secrets Show. And today we're going to be going through the tax structuring playbook. One of the most significant questions that we get all of the time from 7- and 8-figure business owners is, how do I structure myself for tax purposes? As business owners, we're always looking for opportunities to optimize our tax, but there is a fundamental difference between minimization and optimization. And I see a lot of 7- and 8-figure business owners getting this fundamentally wrong. And what does that cost them? Well, sure, they might save some tax in the short term, but they're doing so from a very short-sighted position, which ultimately means that it limits their wealth building, and it can potentially put them at risk of having to pay additional tax in the future, or potentially putting their hard-earned at risk for future generations in terms of asset transfer. I'm going to take you through our complete end-to-end tax structuring playbook that we use internally with our private clients. You've never seen a system that is this comprehensive that you can actually understand. And very interestingly, we had a client who came to us a couple of months back who's working with a Big Four accounting firm and paying tens upon tens upon tens of thousands of dollars for strategic tax advice. And when we took them through this playbook, they said this is the first time that we have actually understood what all of this stuff means. So you guys are in for a treat. Now, I'm going to start by saying that this is general advice. This is not specific to your individual circumstances. I want this to be educational in nature to add more tools to your kit bag, but I urge you to seek your own professional advice. This has been crafted alongside our chartered accounting and tax advisory team and our financial advisory team. So we want to make sure that we tailor this to your personal circumstances. So if you would like to get help with optimizing your tax structure, maximizing your profit, building more personal wealth, the best port of call is for you to complete our Wealth Health Check at wealthhealthcheck.com.au. It'll give you a 40-point financial performance scorecard that'll give you a customized report showing you exactly where you need to focus your attention. So go and complete the Wealth Health Check. There'll be a link in the comments below. So let's get stuck into the details. So we're going to start with the foundational principles of tax structuring, guys. Now, the core philosophy is that the best form of asset protection is not to own any assets in your own name wherever possible, okay? When you own assets personally, everything that you've worked to build becomes exposed to business creditors and lawsuits, professional liability claims, bankruptcy proceedings, family law disputes, and estate complications and probate, okay? So if we think about this in terms of a risk profile, like when you're a business owner, you've got high risk, right? So we usually want to minimize the personal asset ownership and use structures. If you're a company director, same story. If you're a professional, you're a doctor, you're a lawyer, you're an accountant, you're at a high risk of litigation because of your professional liability. And when you're an employee, it's relatively low risk, right, in the grand scheme of things. And also if you're a non-working spouse. So in many cases for our clients who have they're a high-risk individual, we have a risk person in the relationship and we have an asset person in the relationship for the purposes of protecting what you've worked for. So in principle, high-risk individuals should operate businesses and take on liability through corporate structures, while low-risk individuals, usually the spouse who's not involved in the business, holds the family wealth. This doesn't mean hiding assets. This means thoughtfully structuring ownership so that business failure or professional liability doesn't destroy your family wealth over decades. So there are a few key considerations. Timing matters. Asset protection structures must be established before the problems arise. Like, we have some people coming to us scrambling, trying to set these things up. It doesn't work. You have to have done these things retrospectively before the fact, okay? Genuine separation required. Like, structures must be real, they must be properly documented, and they need to be operated correctly. Paper structures that aren't respected in practice offer no protection. And we need to consider the cost-benefit analysis. Like, simpler situations don't warrant complex structures. We have people coming to us who are really concerned about risk, but when we do the evaluation, there's not really a lot of risk there. So the cost associated with it and the added complexity, it needs to be justified before we implement these things. Now, next, the family home. We get a lot of questions about the family home. We see a lot of people make mistakes around this. So, the family home is typically the only major asset that should be held personally because of the CGT main residence exemption. It is a complete exemption from capital gains tax that is only available to individuals. So, to be eligible for that, you must be an Australian resident for tax purposes. The dwelling must be your home for the entire ownership period, and it must not have been used to produce assessable income, and it must be less than 2 hectares. Now, there is the 6-year rule associated with this. So if it was your principal place of residence, you can rent it out for up to 6 years, and it can still be capital gains tax exempt, but we just need to be very careful with the timing, okay? So your situation, both spouses are low risk. We typically own it by the spouse or joint, and we get a full CGT exemption. If there's one spouse that's high risk, we usually own it in the low risk spouse's name only. So it protects the home from business creditors while maintaining that CGT exemption. Both spouses are high risk. The low risk spouse, or we can consider additional strategies. Just be mindful that if we do consider putting it in a family trust or a company, you're going to lose that CGT exemption. So we need, once again, be very careful about weighing up the cost versus the benefit. And then obviously if there's a single person high risk, then we need to consider other strategies very carefully. We need to balance that CGT exemption against the asset protection benefits. So I'll give you an example. The tradie's wife. Michael runs a construction business. He's a director. His wife Sarah works part-time in an unrelated field. They're buying a $1.2 million family home. Michael faces potential liability from construction defects, workplace injuries, and subcontractor disputes. Sarah has minimal professional liability exposure. So in this case, like, Sarah should be the sole homeowner of the family home. The outcome is we get the full CGT exemption. The home is protected if Michael's business faces claims or insolvency, and there's no additional cost or complexity. So of course, Michael's going to contribute to the mortgage, but we need to document this appropriately in the event that there is family law implications down the track. Okay? So the 6-year absence rule. If you move out of your main residence, but you don't acquire a new one, you can continue to treat it as your main residence for up to 6 years, even if you rent it out. So this provides flexibility for work relocations, extended travel, temporary moves, or family reasons. After the 6 years, you can nominate another property, and the exemption is lost for the rental period. So we can be really tactical around this. We've had clients who have had a home as their principal place of residence. They've then bought a bigger property, and then we decide where we use that 6-year rule for the purposes of optimizing for capital gains tax. So we need to be very mindful of that. Okay, so let's talk about trusts versus company for investments. Okay, so what we need to consider is the pre-tax versus post-tax money concept. Like, this is one of the most important concepts in tax structuring. So personal or trust investment vehicle is always post-tax money. So you've earned $100, you've paid up to $47 in tax, and you can invest $53 because all of that money from your company must pass through the trust and then come to you or other beneficiaries in order to invest it. A company is pre-marginal tax money. So a company earns $100, it pays $25 in tax, and it invests $75. So let's do the mathematics of compounding. Scenario, we've got 100 grand to invest, we're getting a 7% annual return, and we're investing that over 20 years. So if we distribute it to an individual and they are paying the top rate of tax, 47%, and then invest personally, they have $53,000 to invest. Their investment returns are taxed at 47% as well. So the net return after 20 years is $127,000. If we retain it in the company at that 25% tax and we invest it at the company level, we have $75,000 to invest. We get taxed at 25 to 30%, depending on if it's a trading business or a passive business. We'll talk about that more shortly. So the result after 20 years is $215,000, right? Of course, we need to distribute it at that point, and there may be eventual top-up tax, but there is a significant deferral benefit, okay? So when to use each structure? We use a trust for investments when beneficiaries are in low tax brackets. So if you have a non-working spouse, you've got adult children, or we've got a bucket company we can distribute to, we can distribute to low-income individuals at 0 to 19%. Next, we plan to hold the assets long-term and then sell. So trusts get a 50% CGT discount available to them under the current rules, right? There is a need for distribution flexibility. So different beneficiaries can receive different income in different years because trusts don't have to distribute in the same proportions every year. And also, estate planning is a priority. Assets pass outside the will and can avoid probate if they are held within a family trust. There is still going to be decisions need to be made around who is the controller, the trustees, and the appointers of the trust, but that can be determined as part of the trust deed. Okay. Now, we use a company for investments when all family members are in a high tax bracket. So, company tax rates of 25 to 30% beat the 37 to 47% tax rates. We want to retain and then reinvest the profits. So there's no forced distribution. We can keep rolling it over at that company tax rate. So we don't need to distribute it, pay the top rate of tax, and then reinvest what's left. We've got a long investment time frame. So compounding at a lower rate outweighs the eventual top-up tax. And deploying business profits. So intercompany loans avoid Division 7A. And Division 7A is a big issue when you're a high-earning income owner. This is the critical strategy. So Division 7A, which treats loans from companies to shareholders as essentially deemed dividends or requires for that to be on a 7-year term, principal and interest over 7 years at about an 8% interest rate, it doesn't apply to company loans. So how do we use it? Well, we have a trading company that earns profits. It pays 25% tax. That trading company pays a dividend to a holding company and it gets franking credits attached. That holding company then lends that to an investment company. There's no Division 7A. And then that investment company deploys the funds into investments. All of those returns compound at the company tax rate, and there's no top-up tax until you eventually distribute it. So this basically means that we've got between a 22 and a 27% more capital to invest compared to distributing it to individuals who are at that top marginal rate. So let's compare these pros and cons. Tax on retention. Trust, 47% if it's undistributed or at the marginal tax rate of the individual who receives that money. Company, 25 to 30%. CGT discount. This is a big argument point. Trusts get a CGT discount because they distribute to the individual. Companies don't have a CGT discount. So this is one of the biggest reasons why accountants usually don't recommend a company structure, but I'm going to show you the math. Distribution flexibility. Trust is high. Company is low depending on who owns the shares in the company. So in many cases, we have the shares of that bucket company owned by a family trust, so we still get flexibility. Losses. Trapped in the trust, they're distributed usually to the individuals. The company trapped in the company. Complexity. Trust is moderate because there's no certainty every single year, whereas a company's relatively straightforward in the grand scheme of things. Trust, exit, sale. Well, you can't sell shares in a trust. In a family trust anyway, you can in a unit trust. In companies, you can sell shares. So that gives us some flexibility in terms of sale. So let's talk about the key considerations for asset structure design, okay? So there are 4 pillars that we need to consider. Pillar 1, risk management. There are the key questions we need to ask. Who in the family faces the greatest liability exposure? Next, what assets need protection from potential claims? And then what is the realistic worst case scenario? So the structural solutions, separate trading activities from asset holding. Like your trading entity is the most high risk entity that you're going to have. That's where you're most likely to get litigated. Then we use corporate trustees to limit personal liability. So if you have trusts, we usually always suggest having a corporate trustee or a company that acts as trustee that you can be a director of, for a couple of reasons. One, if you own it personally, it's easier for us, they kind of pierce the corporate veil. And 2, from an estate planning perspective, it's much easier to reassign a director than it is to change an individual trustee. And we layer entities to create barriers between risk and wealth. So the more layers we've got, the harder it is for people to find out where your assets are, and therefore that complexity creates a cost barrier for people to pursue you. Risk hierarchy. So trading business, it's the highest, okay? Usually we have a trading business as a company and the shares in that company are owned by a family trust. Business premises, that's pretty high. So we usually want to have that in a separate entity or in a self-managed superannuation fund. Investment properties. Medium, we have that in asset protection trust or we have that in a bucket company. Share portfolio, medium risk in a trust or an investment company or bucket company. Family home, protected, usually owned by a low-risk spouse, and superannuation protected in an SMSF or a retail or industry fund, okay? Now, pillar 2 is flexibility of tax outcome. So, can income be distributed to low tax beneficiaries? Can profits be retained efficiently when needed? And can different income types be streamed appropriately? So, based on this, we either look at discretionary trusts for distribution flexibility, we look at companies for profit retention, and we look at streaming provisions for CGT and for franking credits. So when we think about this, an individual tax rate 0 to 18,200, 0% tax rate. A company's 25%, so individual's better. 18,000 to 45 is 16%, so that's compared to 25%, individual is better. Here is where the company tax rate shifts. So between 45 and 135,000 and above, as we can see, the company is better, okay? So then we need to consider pillar 3 is tax planning. So what tax concessions are available? How can CGT be minimized in the event of a sale? And what compliance obligations exist? So here are the key opportunities. The 50% CGT discount until the government chooses to change that. If we hold assets for more than 12 months in a trust or personally, then we get that discount. The small business CGT concessions. So 2 mil turnover, 6 mil net assets test. We have the ability to reduce tax by 75%, even to 100% on a business sale. Franking credits, company structure. We've got to be mindful that a franking credit or tax that's paid in a company is kept on record, and that is transferred with a distribution to the individual who receives that dividend. And what that can mean is that if you're in a lower tax rate than the company rate that's been paid, you will actually get a refund for that tax that's been paid. No other structure has this. And what we end up doing for a lot of our clients is we build wealth in a bucket company, we accumulate all of these franking credits, and then at a later life stage when, say, they're 60 plus, they're retired, they've got no longer active income, we start distributing from the bucket company, and then in many cases we end up getting refunded for the tax that's been paid, or at least a portion of, depending on how much they're drawing. Next is super. We can make personal contributions at 15% tax rate, and then in pension phase, 0%. And then obviously the company tax rate, if it's an active asset, so it's an active business, it's trading actively, we get a 25% tax rate. Now, pillar number 4 is succession planning. So how will assets transfer on death or incapacity? Who will control the structure of the next generation? And then how can disputes be minimized? So the mechanisms, corporate trustees. We have continuity on death. There's no CGT event. We just appoint a new director of the corporate trustee. Appointer provisions. This is who controls the trust. Think about the appointer as an umpire. They get to choose who is in the respective roles of the trust. So that's a really important position. Testamentary trusts. This is providing tax-effective distributions to beneficiaries after death. Death benefit nominations. The amount of death benefit nominations that I see that are expired because they only last 3 years is incredible, and this creates a tremendous risk for your beneficiaries. And then shareholders agreements. So if we have companies, we want to ensure that there are shareholders agreements that govern company succession. Okay. So number 5, a trading trust versus an asset trust. So the core concept is separate your risk-bearing activities from your wealth accumulation using 2 distinct trust structures. So a trading trust, we don't like trading trusts. When businesses trade through a trust, it forces a tax outcome every single year. The company can't hold retained earnings, so it has a working capital issue. It must distribute to beneficiaries, and money needs to be contributed back to the trading trust, usually by way of unpaid present entitlements, which is just it's a huge complexity that many business owners just overlook, and their accountants don't talk to them about this. So we usually suggest that all businesses should run it through a proprietary limited company. The only real exception to that is when we've got real property through that business that's directly aligned with the business, and we don't have the opportunity to strip out the real estate into a separate entity and have the trading business separate from the real estate. Like, for example, some hospitality businesses that have a significant real estate portion, like chalets, resorts, things like this. Sometimes we just can't do it, okay? But asset trusts. This is about holding investments, so property, the shares in the bucket company. This is about wealth protection. So why separate trusts? It's about creditor protection. So if the trading business fails or faces litigation, we want to separate the company from the assets, okay? Section 100A. This is really key, and this is an area that the ATO is coming down on. This is what we refer to as reimbursement agreements, where trust distributions are made to one person, but the benefits flow through to another. So we see a big issue with people distributing their trust proceeds on paper, or saying like, I'm distributing to the kids, or I'm distributing to my auntie or my cousin or whatever, but they actually don't transfer the money. And or worse, they distribute the money and then they recontribute it back, and this creates a lot of issues. So if distributions between trusts, they need to be genuine transactions, and there is no circular flow of funds that can trigger Section 100A. So another big one we see is where people take money out of their company, put it in their mortgage offset, and then contribute it back before the end of the financial year. This can be seen as a trigger of Section 100A. Really important to get advice from your accountant around this. Now, number 3 is succession flexibility. So having different appointers, different vesting dates, and different beneficiary classes. Really, really important. So big thing here, obviously we want to consider separate trust deeds, different corporate trustees, different appointers, clear documentation of purpose, and then arm's length transaction between our respective trusts. So let me give you a case study. David and Emma had built a successful manufacturing business that was worth about 3 million. They also had about 2 million in investment properties accumulated over about 15 years. The current structure, everything was held in one family trust. So a product liability claim could expose both the business and the investment properties. So the restructure in this particular case was the trading trust. So they owned shares in Manufacturing Co., which is what they actually run their business through. We set up the trading trust, which owned the shares in the Manufacturing Co. David and Emma are directors of the corporate trustee, and that's where all of the risk was. And then we had a separate asset trust, which owns the investment properties, owns shares in their bucket company, and then receives distributions from the trading trust for further investment, and it protected the manufacturing business from liability. So the outcome was, if they got product liability claims that exceeded the insurance coverage, creditors could only access the trading trust assets. The $2 million property portfolio was protected. Now, there was some costs associated with doing the transfers, but based on their particular case, they're happy to wear that cost. There was some setting up the new structures, stamp duty, and obviously some CGT consequences that we needed to consider. Okay, so when we consider setting these things up, like setting up a trust deed, usually it's about $1,500 to $3,000, depending on complexity. Corporate trustee, $800 to $1,500. ASIC annual fee about $310. Annual tax return, depending on complexity of how much you've got, is $1,500, and then stamp duty on transfers, and then obviously the CGT, which is case by case. All right, so let's talk about corporate trustees. So a corporate trustee is a company, usually special purpose $2 company. It has really no value. It's just there to act as a trustee. It doesn't own really any assets, rather than an individual person. So the reasons for it: personal liability. Individual trustee is personally liable for any of the trust debts. Corporate trustee is limited to the company or the trust assets. Death of the trustee. The trust is disrupted, potentially a CGT event, and a new trustee needs to be appointed. The company continues. We only need to change the directors. Bankruptcy of the controller. Trust assets are potentially exposed. The company continues unaffected. Asset protection can be very difficult to prove. There is a clear legal separation with the company. Succession. It's complex, and it may trigger stamp duty. Corporate trustee, we just change directors. It's pretty simple and clean. SMSF single member. You can't have a single member SMSF with an individual trustee, whereas a corporate trustee, they can act alone. Setup cost, individual is nil. To set up the corporate trustee, let's call it $1,500, and then an ASIC fee annually. So let's think about liability protection. So when a trust incurs debts, like through contracts, legal claims, etc., the trustee is personally liable. And the trustee has the right to be indemnified from the trust assets. If the trust assets are insufficient, the trustee may have to pay from their own assets. So that could be your house, your car, your savings, everything's at risk, and the liabilities continue even after you cease being a trustee. But with a corporate trustee, only the company's assets are at risk, and the company typically owns nothing except its capacity as trustee. The director's personal assets are protected. The only exception to that is director's liability, if there's fraud or a breach of their fiduciary duty. So we use a corporate trustee for family and discretionary trusts, for trading trusts, for unit trusts, for SMSFs, or any trust where asset protection is important, okay? I'm not going to run through the specifics of how to set it all up, but we'll keep charging forwards. All right, so let's get into the structure blueprints. This is the fun part. Okay, so these are various structure blueprints that we use for many of our clients. Think about these like Lego pieces that we put together to solve particular tax issues or structure issues in certain situations. So Blueprint number 1 is the trading company owned by a family trust. This is our foundational structure for most Australian businesses. It combines liability protection of a company with distribution flexibility of a discretionary trust. So we have a trading co, pays 25% tax. The shares in that trading co are owned by a family trust with a corporate trustee. And then we have beneficiaries. So profits can be distributed to the family trust. We have flexibility around who we distribute as beneficiaries, right? So pretty straightforward. Key benefits, limited liability, trust only owns the shares. We've got distribution flexibility because of the trust. There's a CGT discount on the sale of the company because it flows through to the trust and then to the individuals. Profit retention, we can retain profits at 25% in the company. There's creditor protection because really only the company's assets are exposed. And there's succession. We can change the trust appointers, directors. There's no asset transfer needed. Set up $3,000 to $5,000 and $2,000 to $4,000 in annual compliance, okay? Division 7A risk, we've just got to be mindful that if we are borrowing money from the company to individuals, that we do have Division 7A risk that we need to be mindful of. And also we've got to consider PSI, so personal services income. So if you are running the business and your income is produced primarily through your personal exertion, then we don't have the benefits of the structure distributions. All of that income must come to you. So it's very important that your accountant gives you advice on whether you're at risk for PSI. So if you're a sole like you're the one that's doing the work, you're self-employed, right? Then therefore that's probably a big question that you need to ask. So we use this when business profits are over 100 grand. We've got multiple family beneficiaries. We need asset protection. There's planning for an eventual business sale. If we're a sole operator with low profits, we can consider a simpler structure. But my philosophy on this is we should always set up a structure right from the beginning and we grow into it. So that was something that we want to be mindful of. Okay. So there's things that need to be done. There's annual company tax returns, trust tax returns, the ASIC annual review, trust distribution resolutions before 30 June. We need to set up director IDs, and we've got to do monthly or quarterly BAS and IAS returns, okay? So this just gives you kind of a rundown of your costs. Usually setup costs are between $3,600 and $6,500, and then annually, depending on the complexity of your company, between $4,000 and $9,500 per year, okay? So let's give you a case study. Sarah runs a marketing consultancy. Profits have grown to 180 grand. Her husband earns $60,000 as a part-time teacher. They've got 2 kids, one studying, no income, one's working, earning 45 grand. Previous structure, they were a sole trader, so she's paying 39% average tax. There was no asset protection, and there was no ability to involve family in the tax planning. So we set up a family trust that owns the Marketing Co. Proprietary Limited. So that meant that Sarah could get a distribution of 80 grand, so the tax rate's 23%. Mark could get 45 grand, paying 16%. The adult child could get 18,200. Adult child's already working, so we didn't look at that. We retained earnings in the company, so we ended up paying 34,800 in tax. So there was an annual saving of $19,200. It basically paid back the cost of setting up the structure in less than 4 months. Pretty cool. So let's look at the next one, Blueprint 2, the trading company and the holding company. We're seeing this more and more frequently. This is how I structure my business. I've got multiple trading co's owned by a holding co, so we can create multiple layers to this. But this structure adds a holding company to the trading company, which provides an extra layer of asset protection for retained earnings, and it holds valuable IP. So, trading co pays 25% tax. The shares in trading co are owned by holding co, where we build valuable IP or want to retain profit in the business but want to minimize the risk. So we pass the money up to the holding co. So if trading co is sued, it's basically separated. That's owned by the family trust, so we can distribute through there. We can then distribute through to beneficiaries. So when beneficiaries' average tax rate reaches 30%, usually about 200 grand, we can then distribute to a bucket co, and this allows flexibility over who receives the distributions. And then also the holding co can lend money to the bucket co with no top-up tax or Division 7A requirements. So this basically gives us an extra up to 27% to invest, because the bucket co pays a flat rate of 30% tax. We invest the proceeds inside the bucket co in shares and property, and any tax paid is captured as a franking credit for future distribution. So in the future, if we have beneficiaries who are on a lower tax rate than 30%, we can distribute to them. Pretty cool. So why add a holding co? The ops co is sued or insolvent. We can retain profits in ops co. We can lose those. Whereas if we've distributed it to the holding co, it's already gone upstream. So the holding co is protected. Or a major contract dispute. All company assets are exposed without the holdco. In this, with the holdco, only the operating company is exposed in that particular case. Okay. Same thing with IP protection. So if you've got valuable intellectual property, brand, software, processes, that kind of stuff, it can be licensed, assigned to holdco and then licensed back to the operating company. And we can do this with multi-ventures, right? We can have completely separate operating companies that are owned by the holding co. So that provides a lot of opportunity there. So when do we implement this? Usually when we've got retained earnings above 500 grand, because we've got significant assets worth protecting. We've got valuable IP that we've developed. We've got multiple business ventures. We're planning for an eventual sale because we can sell either each of the operating businesses individually or the holding co, usually for a higher valuation. Or we're concerned about industry risk. It just gives us an extra layer of protection, okay? And this is where the franking credits flow, right? Operating company pays 25% tax. It creates franking credits. It then pays a franked dividend to holding co. That includes the grossed up dividend. And then essentially holding co gets the tax offset for those franking credits. And then obviously that then passes through if it pays dividends to beneficiaries as well. So that's the benefit of franking credits. So there are some compliance complications. Like we've now got 2 company tax returns. We've got to be mindful of the BRE eligibility. So both companies are tested separately around whether they get taxed at the 25% or 30% rule. The franking credit rate alignment, depending on that BRE eligibility. We can have intercompany arrangements, but they need to be documented and be at arm's length. So we're just got to be mindful. Okay. So cost analysis, right? We've got maybe $3,000 a year in extra costs in terms of setup. And another $1,500 ongoing. Once again, that depends on the complexity of the company. So we may have multiple of that. So let me give you an example. James runs a construction company. Over 10 years, the company's accumulated 800 grand in retained profits. The construction industry has a lot of risk, right? So if he has a major building defect, the claim could exceed his insurance and consume the retained profits. So we set up a holding company structure. We created the holding co, owned by the existing family trust. The holding co acquires shares in OpCo. We do a share swap or restructure, which actually avoided us having to pay any CGT. The OpCo declares a dividend of 700 grand to HoldCo and retains 100 grand in working capital. And then HoldCo holds the reserves and the OpCo continues trading. So the outcome is that if there's a defect that arises, we've only got 100 grand plus the equipment. 700 grand is protected. The business can continue through the new OpCo if needed. Cost us about $5,000 to set up and an extra $1,500 a year ongoing. So there's a 700 grand a year protected for $5,000 of investment. It's pretty great value. So let's talk about the bucket company. This is something that's really important as you're earning more profit, that we set up a corporate beneficiary that receives trust distributions, paying company tax rates instead of individual margin rates, okay? So when family beneficiaries are already in high tax brackets, distributing additional to them could mean they pay up to 47% tax. The bucket company catches the excess and pays usually 30% tax. So trading co pays 25%, distributes to the family trust. The beneficiaries are earning 200 grand each, which gives them an average tax rate of 30%. And then we distribute all of the rest to the bucket company and we invest in that structure. Okay. So we usually want to have the shares in the bucket company owned by a separate trust to avoid this section 100A risk, because if the bucket co is owned by the same trust that distributes, it has a higher risk of a circular arrangement. Okay, we usually have a separate trust that's called the asset protection trust, so it has a lower risk. All right, because it's a genuine transaction. All right, so there's a tax arbitrage here. If we have $200,000 to distribute and 2 adult beneficiaries already earn $150,000 each, if we distribute 100 grand to each beneficiary, they're going to pay 82,000 in total tax. Whereas if we put 50 grand to each beneficiary and then put 100 grand into the bucket co, we end up saving about 15 grand in tax. So there's a big part here in terms of Div 7A. So when a trust distributes to a company beneficiary and the cash isn't paid, this creates an unpaid present entitlement. Okay. So post 1 July 2022, UPEs are treated as financial accommodation, effectively loans. Unless the cash is paid before the company's lodgement day, they put it on a complying Division 7A loan term. There is a written agreement before the lodgement date. There is a benchmark interest applied for 8.37%, and it's a maximum 7-year term for an unsecured loan or 25% if it's secured on real property. And there is minimum yearly repayments. If it is non-compliant, the entire unpaid present entitlement is treated as an unfranked deemed dividend to the shareholder. So it basically means double taxation. It's the worst possible outcome that you could have, okay? So We need to be mindful as well the investment strategy is in place for the bucket company, because I see a lot of people just accumulate cash in their bucket company and do nothing with it. So the bucket company pays a flat rate of 30% tax. We need to invest the proceeds into shares and property. Any tax paid is captured as a franking credit for future distributions, and that allows us to potentially get tax-free refunds at later stages of life if you're at a tax rate of lower than 30%. So the long-term strategy. Bucket Co accumulates investments over the working life. Franking credits build up. In retirement, we pay franked dividends. The franking credit refunds convert company tax paid to personal refunds, and the effective tax rate over lifetime is significantly reduced. So, for example, tax saving, there's a benefit of 30 versus 47%. The value here is up to 17% on distributions to the bucket co is a benefit, right? Franking credits accumulated. That gives us future tax offsets. Investment compounding. Because we've had that extra 17%, we've got higher compounding. And then the asset protection. We are protecting our investments by having it under a company, so we're minimizing the risk. So in terms of the costs, typically $1,500 to $2,000 a year in total for those kinds of things, once again, depending on the complexity and the number of investments. So if all beneficiaries in the top marginal rate, we use a bucket company. Excess tax income after filling low tax brackets, long-term wealth building goal, we need to retain profits for investment. If beneficiaries are in low tax brackets, we usually distribute to them, assuming that's possible. And we have a short-term income spike. We can be tactical around that. And we've got to be mindful of Division 7A, right? Compliance. It's a big risk. So let me give you a case study. Dr. Chen runs a medical practice through a family trust. Annual profits of 450 grand. His wife already earns 180 grand. Their two adult children are high income earners, 120 grand each. So all of the family members are in high tax brackets, so their distributions are going to face 37 to 47% tax. We implemented a bucket company. So Dr. Chen, 100 grand, would be 45% plus Medicare, so that's 47 grand in tax. Mrs. Chen at limit, 10 grand, that's 4.5 grand in tax. Bucket company, 340 grand at 30% is 102,000 in tax. So the alternative, all to Dr. Chen, is 200 grand in tax. In this particular scenario, there's an annual saving of 46,500. Now, you might be wondering, why didn't we just put it all into the bucket company? Well, we need to distribute enough to the individuals for them to achieve their personal lifestyle goals. So that might mean that we have to pay top rate of tax, because we don't want to put money into the bucket company and then pull it out, because then we've got Division 7A issues, or we're going to have to pay the top-up tax anyway, okay? So bucket company after tax retention is 238,000. Over 10 years at a 6% return at 3.3 million accumulated. That means we've got about $1 million in franking credits, and we have that available for distributing when they retire. So pretty cool. Now, unit trust. This is a very misunderstood structure. The unit trust allocates income and capital based on fixed unit holdings rather than trustee discretion, okay? So income allocation. The trustee decides each year with a discretionary trust, whereas unit trusts, they own units, kind of like a company. When you own shares in a company, you have a fixed entitlement. Entitlements, there's no fixed entitlement in a discretionary trust, whereas unit trusts are fixed. Flexibility is high for a discretionary trust and a unit trust is low. JV suitability, we don't usually do JVs through a discretionary trust. We usually will do them through a unit trust. And CGT discount, they both have that because it passes through to the individuals. So we use a unit trust when we do joint ventures. So let's say we've got a joint venture partner that we're looking to buy a commercial property. If we're doing a property syndicate, if we have unrelated parties, so these are not family members, not that they don't trust each other, but they don't trust each other. Right? We want fixed succession. We want defined interest to pass to specific beneficiaries, or there are certain borrowing requirements, particularly with unrelated parties. Banks prefer unit trusts for property in these particular instances. So fixed trust status. It's got to be mindful that not all unit trusts are fixed trusts for tax purposes. There can be hybrid trusts, so just got to be mindful. So the fixed trust status, the requirements of beneficiaries have vested and they have indefeasible interests, meaning that they've got a fixed entitlement and that those don't change unless those units are sold or bought. Trustee doesn't contain powers that could defeat those interests. Okay, why this matters? Fixed trust status affects franking credit streaming. It affects trust losses recoupment rules, and it impacts the CGT, okay? So I'm not going to get into too much detail, but basically what we usually do is we have beneficiaries, we have a bucket co who could potentially have ownership in a unit trust, The unit trusts are an alternative structure to a company that provide unitized access to assets owned by the trust. And this is common in joint ventures. So, for example, if we had money in the bucket company, we wanted to go and buy a big commercial property under a JV structure, we would potentially go and set up a unit trust for the JV, and the bucket company would own the shares in that unit trust for the purposes of the JV. Okay. All right. So, give you an example. Let me just fix this up, make it look a little bit prettier. So, unit trust income, 500 grand. We've got family trust, a unit holder, family trust A has 40 units. They get a 40% entitlement, so that's 200 grand. Family trust B, same thing, 200 grand. And investor C has a 20% entitlement and they get 100 grand. There's no discretion. It has to be distributed. So, the pros and cons. Pros, certainty. All parties know exactly what they're going to receive. JV appropriate. Unrelated parties can invest together. CGT discount flows through to individual unit holders. Property suitable, like it gives clear ownership percentages for the property, and there's a clear exit mechanism. You can sell or buy units between parties. Okay. Cons, it's inflexible, so you don't have streaming opportunities because of the fixed entitlements. Stamp duty, unit transfers can attract duty, unlike share transfers in many states. Fixed trust issues, the deed needs to be drafted really carefully, and it's not really family friendly, right? Cannot benefit different family members in different financial years, which comes back to that inflexibility. So let me give you a case study. Two families want to jointly purchase a $2 million commercial property. Family A contributes 800 grand, 40%. Family B contributes 1.2 million, 60%. So we set up a unit trust with a corporate trustee. The family A has 40 units. Family B has 60 units. There's annual rental income of 160 grand. So family A gets 64,000. Family B gets 96,000. Each family trust then distributes to its beneficiaries as appropriate, right? On sale after 15 years, we sell it for 3.5 million. Family A gets 600 grand share of the sale. They get a 50% discount, so they're going to pay 300 grand in tax or taxable gain. And then family B has 450,000. That flows through from the unit trust to the family trust to the individual beneficiaries, and they would then have to work out their own tax. All right, SMSF, or Self-Managed Superannuation Fund. So, an SMSF provides tax-advantaged retirement savings with flexibility to invest in a wide range of assets, including business real property. So, the key benefits. In accumulation, income tax is 15% and CGT is 10%. So, it's a 1/3 discount. In pension, when we move it to the income into our drawdown phase, 0% income tax, 0 CGT. So, when we compare that to personal of up to 47% income tax, and up to 23.5% with the CGT discount, there's a real significant benefit here. Now, we've got to be mindful there are some other taxes, Division 293 tax. So if you earn more than 250 grand a year, you'll actually pay 30% instead of 15% on your contributions. And there is now recently implemented Division 296 tax, which is based on your balance. So if you've got over 3 million, you will pay 15% instead of 0. And if you have over 10 million, then you will pay 30% instead of 15. So the point here being that they just want to provide appropriate tax efficiency depending on your income and your wealth status. Okay. So let's go through the structure diagram, what this looks like. So the SMSF is completely separate from your group, but the SMSF allows more flexibility for investors to own direct property. So for example, many of our clients will buy a commercial property and they will actually lease it back to the business on commercial terms. And the other benefit is that we can make pre-tax concessional contributions, so up to $30,000 a year at the moment, and we can make after-tax non-concessional contributions of $110,000. There are a number of other contribution rules depending on your balance and whatnot. Now, the big benefit of SMSF is what's called a limited recourse borrowing arrangement. So we can actually borrow money inside the SMSF to purchase property. Now, there are key requirements. It has to be a single acquirable asset. So we cannot buy a multi-site dwelling. We cannot have something that's subdivided. We've even had issues with certain clients who buy a commercial premises that has a parking space on a separate title. That requires us to either buy the car space in cash or to do it through a separate LRBA arrangement. It is limited recourse, which means the lender is limited to only claim on the asset that is secured, so the property itself, none of the other SMSF assets. Now, it needs to be an arm's length, so the interest rate and the terms must be commercial. It's a holding trust, so it's held in a bare trust until the loan is repaid, which is what allows it to be limited recourse. And we can't make capital improvements until the loan is cleared, okay? We can only do maintenance, so we can't renovate, do those kinds of things with borrowed money. So, contribution strategies. We can make concessional contributions. Okay, so our concessional or pre-tax contributions are either employee contributions, salary sacrifice, or personal deductible contributions. So from July 2024, and they do index this over time, the cap is 30,000. The 5-year carry forward rule is available. So if your total super balance is less than 500,000, you have the ability to use any unused caps for the previous 5 years in one go. We have many clients who time this with, say, an investment property sale, where they make that contribution and they utilize that to offset some of the capital gains tax, which is a pretty cool strategy. So our contributions are usually 15%. Versus up to 47%. Personally, obviously, the thing to be mindful of is Division 293 tax. Now, our non-concessional after-tax contributions is personal contributions with after-tax money. So we have the ability to contribute up to 120,000 per year, or we can use what's called the bring forward rule to contribute 360,000. Now, we can time that as well. So we can put 120,000 before 30 June and then put another 360 in the following financial year to use the bring forward rule. That then means we can't contribute for another 3 years of any non-concessional. Now, be mindful, we're doing this with after-tax money. So usually non-concessional contributions are for our clients who have already built a significant amount of wealth individually, or are getting closer to preservation age or age 60, where they can get access to the money. Now, we've got to be mindful that there's no tax on contributions. Obviously, earnings are still taxed inside, so 15% on accumulation and 0% in pension. So that pension phase, all earnings become tax-free, okay? Any rent from the business property, tax-free. Capital gains on sale, tax-free. Dividends from shares, tax-free. So we actually get a refund for franking credits. So that happens from age 60 onwards. Now, let me give you a scenario. So we've got Mike and Lisa who run a physiotherapy practice. They currently rent their premises for 80 grand a year. They've got 400 grand in their combined SMSF, and they can actually purchase a suitable property for 700 grand. So we borrow 300 grand via the LRBA. We purchase a commercial property for 700 grand. The SMSF leases the property to the practice for 80 grand a year, which is the market rent. The practice claims the rent as a tax deduction, as they were doing anyway, so there's no real impact to the practice. The SMSF receives the rent and then pays 15% tax on net income. So if we have a look at this, obviously rent received 80 grand, the loan repayment P&I is 28,000, property costs, net income, tax 6 grand, so there's $34,000 net to the SMSF. So comparison to personal ownership, they'd pay $15,600. So the net benefit after tax is $24,400 in the grand scheme of things on the basis of $40,000 a year. So the annual net benefit to the SMSF is $9,600. Of course, in retirement, the difference between the two is $15,600 because the SMSF wouldn't pay any tax at all. So, thing to be mindful. Market rent has to be documented. We review that annually. We need a written lease on commercial terms. The SMSF has to be audited every year. There needs to be mindful for related party. We can do a related party on commercial property, but not residential real estate. And we need to be mindful of the sole purpose test. So the SMSF must make decisions on the basis of the beneficiaries for their benefit in retirement, not for their own personal benefit as business owners. So in terms of costs, usually an SMSF costs us about 3 grand to set up. Annual administration is usually between 2 and 4,000. There's an audit cost that needs to be done each year between $500 and $800. We've got to pay a corporate trustee fee of $310, set up the LRBA about 3 grand, and then obviously we've got stamp duty and legals. So generally we consider this when you've got at least 200 grand. Probably these days it's more like 300. We've got to consider whether we need a business premises, so that could be really helpful. How long we have to retirement. Obviously, we've got longer benefit for tax concessions, but it's also longer before you access the money. And we've got to have capacity to contribute. So that really depends on your personal planning and your personal goals. And then we've got to be mindful of the compliance. You can't just abdicate responsibility. You as the trustees are personally responsible, so you need to learn this stuff. In fact, the ATO will actually, in many cases, quiz you before setting up an SMSF, and that goes for both trustees. So you really need to understand your stuff. We take our clients through a pretty robust educational exercise prior to setting this up. So, complete structure. We need to have an integrated strategy, right? The architecture. Risk stream, business operations. So trading co, holding co, risks trust, beneficiaries. Asset stream for wealth accumulation. Asset trust, bucket co into investments. Plus SMSF and plus any unit trusts for joint ventures, okay? This just gives us an idea of the flow of funds. Trading co pays the tax, frank dividends, goes to the holding co, retains profits, protects IP, distributes the risk trust, goes to beneficiaries, then into the bucket co, the asset trust, and then buys investments, or direct to the bucket co. Or we can loan from the holding co to the bucket co if needed to avoid having to have any Division 7A. And it's exempt from that. And then the SMSF, we own the business premises, we lease that to the trading co. Pretty straightforward. So key strategic elements. Trading co, 25% tax. Holding co for asset protection. Intercompany loans without having to pay top-up tax, giving us an extra 27% to invest. The bucket co, owned by an asset trust to avoid Part 100A circular arrangement issues. SMSF for the business premises, because if you're paying the money, why not put it into your own pocket? And this just gives us an idea of when we start adding this stuff or how quickly we can set this up. Because I set this all up originally when I started my business 8 years ago, knowing that I was going to grow into it. We've now got a $25 million business, but this gives you some indications. So starting, less than 100 grand, trading co and the trust, foundation. Growing, 100 to 250, we add the beneficiary distributions. Established, 250 to 500k in profit, we add the bucket co and the asset trust. Mature, when we are 500k plus, we add the holding co. Once again, there can be some consequences. So in many cases, if we're going to grow to that, we want to do that originally. Wealth building, surplus cash, investment co, and the intercompany loans. Property, we need a premises. We can look at the SMSF. And then expansion, JV opportunities, we look at the unit trust. So once again, like if we set up everything, it's probably going to cost you about 12,500 to about 18,500 to set up. And then in terms of annual ongoing, between 10, just call it 11,000 and 22,000 a year. But we've got to consider the potential benefits. So distributing for lower tax beneficiaries, 10 to 50 grand a year tax saving. Bucket company tax arbitrage, 10 to $30,000 a year. Company profit retention, $15 to $15,000 a year. Intercompany loan structure, obviously that varies. SMSF tax advantages, $5 to $20,000. The asset protection, well, it's really unquantifiable, but it can be significant. So the potential total savings per annum, depending on your situation, is between $40,000 and $150,000 or more per annum. So if we think about this, like setup cost 15 grand, annual cost 15 grand, annual tax savings, let's call it 50. The net benefit first year is 20,000. So the payback period is 4 months if you set this up appropriately. So we just got to consider the risks. Division 7A is probably the most significant risk for business owners, thinking that the business money is their money. Section 100A, the ATO is going really hard on this stuff. ATO audit, they're increasing their audit capabilities and they're chasing business owners, so setting this up appropriately is really, really important. The BRE eligibility loss, like obviously the passive income between the 25% and the 30% tax, it's a significant amount over time. If we can avoid having to go to the 30% for the passive ownership, then that's going to be ideal. Avoidable transactions, like transferring assets when insolvency looms or trying to set this stuff up after the fact, it's a no-no. And complexity, like you need professionals to help you with this, people who specialize in this, okay? And don't set up these structures if you're not planning to scale to these levels, right? Like low profits, you can keep it simple. You're a single beneficiary with no family, right? You can use the bucket company, but you just got to be mindful that the opportunities for tax minimization may be limited. Short business lifespan, you might not recover the costs. You can't afford the compliance ongoing. Like there is an ongoing compliance requirement, so that becomes an issue. Or if you're a personal services income PSI issues, these structures aren't necessarily going to benefit you, okay? So we've got an implementation checklist that you can run through. And I guess the conclusion is, guys, be mindful of the assets that you own personally, family home for low risk spouse, trading through companies for liability protection, using trusts for distribution flexibility, separate risk from assets, always use corporate trustees, bucket companies provide you with tax arbitrage, intercompany loans, avoid Division 7A, SMSF for business premises, and build progressively with proactive advice. So if this has taught you anything, guys, and if you want to get access to this guide, you can do so as part of the Wealth Health Check. So if you go to wealthhealthcheck.com.au, complete the financial performance scorecard, you'll get a copy of this playbook along with all of our other best resources, all of my best-selling books above me, and it will provide you with all the tools that you need to be able to maximize your profit, optimize your tax, and accelerate your path to creating financial freedom faster. I hope you've enjoyed this podcast. This has been another episode of the Financial Freedom Secrets Show, and we look forward to catching you on the next episode.